Hello, hello traders, welcome back again. Today I want to show you the simple 1 minute zone trading strategy that I trade, that the strategy I always use when I'm trading on 1 minute expiry time. Okay, what I mean is that sometimes I trade the 1 minute candle, okay, with a 1 minute expiry time. And sometimes I trade 1 minute candle with 5 minutes expiry time. So, but in this video, I'm going to show you how I trade the 1 minute candle with 1 minute expiry time. I got a lot of requests on my YouTube channel, also a private message that I should make a video show you exactly how to enter the trade and what you should observe whenever you enter a trade on 1 minute. Okay, so this is the video. I'm going to show you a simple 1 minute zone trading strategy. Okay, what I mean by zone trading, I'm talking about supply and demand. Okay, I'm talking about supply and demand in a 1 minute trading strategy. Okay, and in case you want to apply for private section on a binary, okay, the registration is still on, so you can check my contact details in the video description below. So okay, so now let's continue. Uh, what I'm trying to say is that I want to explain what we mean by supply and demand. Okay, when we are talking about supply and demand, we are talking about a popular analysis technically used in day trading. Okay, we are not popular technical analysis. Okay, whereby sometimes we draw a rectangle zone, then we wait for the price to reach the zone, then we enter the trade. Okay, or sometimes wait for price to break the zone, then we enter the trade. So the zone are the period of sideways price action that come before explosive price move and typically marked out using a rectangle tool. Okay, so what I mean is that what I'm saying here is that sometimes market move in a sideways for a short period of time and finally explode to the upside, okay, or it might decided to explode to the downside. So in our entry, we have to wait for price to come back to this zone, okay, wait for price to come to this zone, then we'll enter the trade. But remember, if you want to trade in binary, there's how you're going to trade in binary. So it's not all the time you wait for price or you expect price to reverse on a particular supply and demand zone. So it's just a typical a zone that we have marked out using the rectangle tool on our chart. So um, when we talk about supply, okay, when we talk about supply, we are talking about a supply zone formed before a downtrend. Okay, a supply zone formed before a downtrend. Take a look at this example here. We have this downtrend and the supply zone formed before a downtrend. Now, also, I even indicate that the supply zone here is a single candle base. Okay, what I mean by single candle base, I'm talking about a particular zone. For instance, we have a zone here. Here, some market approaching the zone. The market reverse or touch this particular zone. Okay, we have a particular supply zone here, and the market continue to push higher. Okay, and finally reach the zone and start to reverse. Okay, so the zone here we call it a single candle base because this is the last green candle, the last green candle before we have this strong sellers movement to the downside. So the last green candles are single candle base. So how do we draw it? We draw it from the opening of the green candle to the close or the next high. Okay, so the high can be a shadow or it can be no shadow. Okay, no wick. Sometimes there must be a wick and sometimes there's not going to be a wick. So you draw from the opening of this green candle to the closing of the price or the highest the highest level the price has reached before this downward movement. So that is why I say that the supply zone formed before a downward movement. Okay, supply zone formed before a downward movement. You can see this strong momentum of sellers. Okay, notice the sellers movement here. You notice that the price keep pushing down, even though buyers try to enter multiple times. Okay, for instance, after sellers has break out from this zone, they continue to push down. A few buyers entered, sellers entered again. A few buyers entered, sellers entered. A few buyers, sellers. A few buyers, sellers. Notice that there are few buyers are trying so hard to enter, but it seems the price is going down. That means the sellers are in control of the market. So in that case, all we have to do is look for a zone, a particular zone, or a particular sideways movement. Okay, this sideways movement occur before it occur um, before an explosive to the downside. Okay, you can see this movement. Okay, the sideways movement has occurred here. So we wait for the price to come to the zone, then we enter the trade. Now pay attention. When the price close inside the zone, that is when you should open the trade. Don't trade if the price rejects. Okay, this is 1 minute trade. Okay, 1 minute trade, you follow the instruction. What I'm saying, follow the instruction I'm saying. So don't trade if the price rejects from the zone, then reverse. No, only trade once the candle close inside the zone, then trade the next candle as a bearish using the 1 minute expiry time. Okay, but I suggest you trade 1 minute because sometimes the 5 minute might not be accurate, because sometimes the market might only just reverse once, then the next candle continue to push higher. No, so that's why I say this is a 1 minute trading strategy. So you trade 1 minute, wait for the price to close inside the zone, then take the trade. Okay, now let's talk about the multiple candles supply. Multiple candle supply. Take a look at this example here. This is a multiple candle supply. Okay, we see the price, the bullish movement here, and we notice the price start to consolidate for a while. Okay, sellers, buyers, strong sellers, buyers, sellers, buyers, then sellers. You can see that the market move sideways. Okay, market moves sideways, and finally we have a downward movement. Okay, we have a downward movement. So the price has left the zone. Okay, the price left the zone, then start to move downward. Okay, so in this area here, this indicates that the buyers and sellers are fighting. Okay, it indicates the buyers and sellers are fighting. So just like a tug of war. In this situation whereby we have the buyers try to push the price higher, sellers penetrate, they push the price down. Buyers again try, sellers push then the price down. So they continue to fight. When the price reach this area, we have a rejection. When the price reach this area, we have a rejection. When the price reach this area, we have a rejection. Until finally, there wasn't no rejection on this candle. You can see there was no rejection on this candle. So sellers move down very strongly. So in that zone here is where we actually going to enter the trade. So we wait for the price to resume back to the zone, then we enter the trade. Now, like I said, this is 1 minute trade, okay, and it's very much important to observe the market. Take a look at this. Why I draw the zone here? Why did I even put the line here? Because you notice that after we have this strong bullish movement, we have rejections from buyers around this area. But this candle here, this movement here is the only this movement is the only close and open price. Okay, it's the only close and open price that indicates the buyers are weak. Okay, it indicates the buyers are weak because if you notice the price try to go down for some time around this area, but the buyers push the price down. So anytime the price comes to that area, the price keep pushing higher. But here, this is the lowest closing of this red candle, of this bearish candle, the lowest closing of this bearish candle, which indicate that the buyers are weak here. So immediately the buyers reject the sellers, buyers entered immediately. Okay, we also have the next closing of this bearish candle. We also have the previous closing of this bearish candle and the closing of this bearish candle. So you can see that I've indicated the closing of bearish candles in this zone. We have this, we have this, then we have this. Then. So this is the lowest point, the lowest closing price. Okay, this is the lowest closing price. The buyers take over. So that indicates that this is the area we expect, or this is the zone the market is expected to reverse. Okay, you notice that here we have rejection, also have rejection, 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 but here no rejection. That is a sign the buyers are weak, and this is the lowest closing price of the bearish candle. So immediately the sellers break out from the zone. There was no sign of buyers as well. Also, there's a strong bearish candle. So this indicates that this is the next point of interest. So what we need is wait for the price to continue to push higher and close inside the zone before we execute the trade. Now, observe what happened here. Immediately this candle, this bullish candle reached the zone. Okay, there was a rejection from sellers. Okay, there was a rejection from sellers. But instead, sellers should enter because the buyers are still more active in the market. That is why we have this next candle was green. That is why I say always trade 1 minute candle, because a lot of time I say, oh, this candle has been rejected from sellers zone. Next candle will be red. No. Wait for the bullish candle to close inside the zone. Otherwise, you will lose the trade. Notice that immediately this candle also reject from the zone. The closing price wasn't inside the zone. Okay, so which means that the next candle has to close inside the zone before I enter the trade. So I think I enter the trade here for 1 minute expiry time. Okay, and see, almost close inside the zone, but this candle it closed inside the zone. Okay, and it's also a sign of reversal. So that's why I go with sellers on the next candle. Okay, very simple, very simple. So always trade if the candle close inside the zone. Now let's just talk about the demand. What we mean by demand zone, we are talking about a demand zone that formed before an uptrend. Okay, a demand zone that formed before an uptrend. So this is the demand, and this demand is called the single candle base. Okay, it's called the single candle base because this is the last red candle before this explosive move went to the upside. Okay, and remember I talked about sideways movement as a entry supply and demand zone. So you notice that this rejection, this candle here, has a lower rejection and also has an upper rejection, but close with a tiny body. Okay, it has something like this: up, lower, then now close with a tiny body. Okay, it might be dancing for a while, for a while, for a while, then finally shoot out to this level and drop down. So this is how it formed. Okay, so immediately the price has to continue to push higher. It has to use that as a let's say the supply, demand. Sorry, the price must use that as the demand. So which means that from here it's actually the zone. From here, but this is the body. Okay, this is the body. So from here to this is actually the zone. So which means the price is expected to at least drop to the zone and reverse. That is the that is how this red candle formed. Okay, so now pay attention to this. Why is it that this candle close inside the zone? This red candle closed inside the zone, and instead of bullish candle, the next candle still form red. Okay, because you might have said that okay, let's go with buyers on the next candle, but unfortunately, you end up losing the trade because the candle closed as red. You know why? Observe. Take a closer look at this analysis here, or this price action here. Okay, this is the demand zone, right? This is the demand zone. We expected the price to close inside the demand zone, then we have to trade. But unfortunately, what happened is that this last candle, this red candle that closed inside the zone doesn't have any rejection from buyers. Okay, doesn't have any rejection or doesn't have um, lower shadow. For instance, what I mean is that this is a zone. Then you see the market approaching the zone, then close inside the zone. So our expectation is that next candle will reverse, right? But if there's no confirmation as a rejection, or let's say a shadow that will confirm that the price is reacting to this zone, okay, the market is expected to continue. But if there is a confirmation or if there's any reaction inside the zone, the market is expected to pass, okay. But in this case, it's quite different, okay. The market doesn't react inside the zone. What happens next? Sellers has to enter the next candle. So when sellers entered on the next candle and a very weak and there's a rejection, okay, you can see a weak candle, but it's still inside the zone, a weak candle and a rejection. So we have the next candle from green, okay. With 5 minutes, the market still went up, but I prefer you trade the 1 minute expiry time, okay. So the next candle is one, which is the, what I'm saying is that if you have a zone and you see the market approaching the zone, okay, if there's no rejection, don't trade. Okay, don't trade if there's no rejection. Okay, but if you want to take the risk, you can say that there's no rejection. Well, you should trade the next candle upside. No, well, that is a risk taking. You can trade the next candle upside. But if you want to be careful and you don't want to take any risk, or maybe you're afraid to lose the trade, or you're not sure that you're going to want the trade or lose. So what you have to do is wait for candle to close inside the zone with a rejection. There's no rejection, don't trade. If there's a rejection, trade. Okay. So with the rejection, that will give you 100% confirmation the market is expected to reverse. So this zone we call it a single candle base. Single candle base. Now let's talk about the multiple candle base. This is multiple candle base. This is how it looks like. Okay. You see, the after this strong downtrend, market start to move sideways for a short while. Okay, for a short while, market start. Then finally, the price break out from the zone or from the range. Price break out from the range. Instead of reversing, no, the price did not reverse, but instead the next candle was green. Okay, market also consolidated for a short while, and we have a strong bearish movement, strong bearish entry. Okay, so in the moment the candle return back to the zone, what happened next? We have a bullish candle. Also, the moment the candle closed inside the zone, there was a rejection. Okay, there was a rejection from buyers. If this candle doesn't have any rejection, so don't ever trade down. Okay, don't ever trade down or don't ever take any trade here. Wait for a rejection. So it is better for you to wait for the right moment and right entry than to lose the trade. Okay, it's better to use for you to miss a trade than to lose the trade. So if there's a rejection, you enter the trade. If there's no rejection, don't enter the trade. So that is how you trade supply and demand, and this is how I trade supply and demand. In case you want to know more about supply and demand, okay. Um, let me show you. Let me tell you one more thing about the tips in trading supply and demand. Okay, these are the tips. Okay, wait for candle to close inside the zone. I've mentioned that before. So wait for candle to close inside the zone with rejection. Okay, wait for candle to close inside the zone with rejection. If candle did not close inside the zone with rejection, don't trade. Okay, don't take any trade. Okay, Don't trade if next candle open with gap below or above the rectangle zone. What I mean here is that if we have the zone, okay, let's say this is the zone, then there we see the markets start approaching the zone gradually, okay, then close inside the zone with a rejection. So our expectation is to open trade on the next candle, right? But if there is a gap, what I mean by there's a gap is that market open next below the zone, somewhere around here. So what we do here, sometimes the market might reverse to the downside, or sometimes the market might still form one more green candle before it finally reverse. But for you not to fall into the trap of these tricks here, don't open the trade if there's a gap. Okay? Don't open the trade if the price gap to the downside. Don't open the trade. Okay? Because it's not safe and you are not sure, you are not quite 100% sure the market is going to form one more green candle or it's going to close as red on the next candle. So it's better for you to be safe. Don't trade if the price gap to the downside. Okay? So don't trade if next candle open with gap below or above the rectangle zone. Okay? So only trade if the candle open inside the zone. If the next candle open inside the zone. Okay? Opening price. Okay, opening price of bullish start from low, while opening price of bearish start from the high. So if this candle is going to open inside the zone, at least it's going to be a bearish candle. But if they open below the zone, this zone is expected to form a green candle next. Okay, so and always trade the first attempt. Always trade first attempt. Okay, always trade first attempt. What I mean is that when you are trading supply and demand, always trade first attempt. First attempt is more accurately than second attempt or third attempt. Okay, what I mean is that okay, if you're having a zone here, then markets reach the zone or approach the zone gradually, and we have a rejection, and the market reverse. Okay, it reverse very strong. Then also it's rise again. Okay, and keep pushing to the zone. Okay, then you saw a rejection. Well, our expectation is that we expect the price to continuously reverse anytime the price reach the zone, right? But as a binary trader, you must not trade the second attempt. Don't pay attention to the second attempt. Always trade the first attempt. Trade the first attempt. This is the first attempt when price reach the zone. The first attempt is that the market got rejection and reverse the downside. So you have already won this trade. But if market likely or if market decided to go up the next time and reach the zone, react inside the zone with a rejection, well, it is not 100% accurate. The price is going to reverse. It might still continue, or it might not even respect the zone. Okay, it might not respect the zone. It might still violate the zone and continue to push higher. Same thing goes to demand. Okay, same thing goes to demand. We have a demand zone. Then you saw the price approaching the demand zone. Then candle close with a rejection, and next candle form something like this. Okay, then next candle, next movement, the price still visit the zone one more time. Well, I will likely recommend you that you should not trade this time. Okay, you should not trade this time. It might reverse. Okay, in favor of other traders, it might reverse. But don't trade second attempt. Always trade first attempt. Okay, this is the first attempt. If market return back to the zone, don't trade. Avoid. Wait for the next trade opportunity. Okay. So these are the tips of trading supply and demand, and that is how I trade supply and demand in my trading videos on my YouTube channel. But one thing I want to let you guys know is that not all the time the market will always reach supply and demand. Even though you have a good reaction or a good confirmation to go with sellers on the next candle in this situation, not all the time the market will always reverse. Sometimes the market might give you a rejection, but still continue and not reverse. Okay, but I'm going to show you in my next video. I'm going to show you different kind of supply and demand zone that you should trade. Okay, not all the time you see a base. Okay, a demand base, a supply base, then always decided to and you decided to enter trade. No, I'm going to show you different kind of market base and the way the market has to present itself. Okay, you must also look for fair value gap. You must look for the liquidity strip. You must look for inducement. Okay, and so many other market confluence before you decided to enter the supply and demand zone. Take a look at this example here. Take a look at this example here. Okay, so you notice what happened here is that, okay, this is what we call the liquidity. Okay, market form liquidity here. But sometimes the price decided to drop, touch the zone and fail, but not able to touch the zone, fail to touch the zone, but finally touch the zone and reverse. Also here we have break of structure. Okay, we have break of structure. Also we have change of character. Okay, we have change of character. These are some other market confluence you can apply whenever you are trading supply and demand. So don't just trade supply and demand or draw supply and demand without finding any of these trade setup. Okay, this is change of character, bridge of structure, the inducement, and finally the market reach the zone, and finally reverse to the upside. Okay, maybe my next video I'm going to show you, or if you want to learn more about supply and demand in details, just check my contact details in the video's description below. Okay, so I hope this video will help you a lot to understand how to trade supply and demand. So if you have any question, just check my or just comment in the section below. Check my contact details. Send me a direct message. Okay. I hope you enjoyed this video. So if you like this video, please like, share, and subscribe. Thank you.